Okay, imagine this. A huge tech company puts out record revenue numbers, just blows past expectations. And then its stock actually dips right after. Sounds weird, right? But, the numbers often tell a much more interesting story below the surface. Today, we're doing a deep dive into AMD's second quarter 2025 results. We want to really unpack what drove their performance, figure out what hit their profitability, and see where they're going with AI.
Right. And we're looking at AMD's own official release, their earnings slides, plus some news analysis to get, a rounded view of things, multiple angles.
Okay, let's get into it. So AMD reports this record Q2 revenue, $7.7 billion.
Huge number. That's up 32% from last year. Even beat what the analysts were predicting.
Yeah, so on the surface, looks like a home run, doesn't it?
It does, but here's where it gets fascinating. While that revenue number soared, the gross margin basically, how much profit they make on sales, it actually took a noticeable hit.
Oh, how much of a hit?
Well, the official GAAP margin was 40%, down from 49% a year ago. And even the non-GAAP one, which they often highlight, fell to 43% from 53%.
Wow, okay. That's not small. So sales are up, but profitability per sale is down. Why? What happened?
This is the key part. Our sources all point to one major factor, about $800 million in charges, inventory write-downs, and related costs.
$800 million. That's a big number. What were those tied to specifically? It wasn't just slow sales, was it?
No, not at all. It was directly linked to the U.S. government's export controls, specifically restrictions on shipping their Instinct MI308 data center GPUs to China.
Ah, okay. So a geopolitical factor hitting the bottom line.
Exactly.
Yeah.
And it's a major impact. If you actually take those charges out, AMD's non-GAAP gross margin would have been around 54%. Much healthier.
Right.
To put it another way, those restrictions basically cut their earnings per share by about 43 cents. It really shows how these external things like export rules can seriously affect a company's finances, even when their products are in high demand.
So this difference between GAAP and non-GAAP figures, it's pretty important here then. How should we think about that when looking at their actual profitability?
It's crucial. GAAP, generally accepted accounting principles, gives you that standardized view. Everyone uses the same rules.
Okay.
But non-GAAP often excludes these one-off items, like these export charges, that management feels don't reflect the core day-to-day business performance.
Like a temporary blip, almost.
Sort of. Think of it like if your factory had a fire. It's a real cost, impacts your reported profit massively that year. But it doesn't mean you suddenly forgot how to make your products efficiently.
They got it.
So for AMD, non-GAAP helps them and investors see the underlying operational strength without that big sudden hit from the export controls skewing the picture. They want to show the core engine is running well.
That makes sense. So core business strong despite the external shock. Okay, with that context, let's break down the business segments. Where did the actual growth come from?
Well, the data center segment was definitely a highlight. Revenue there was $3.2 billion.
Up 14% year over year.
Exactly, and that was mostly driven by really strong demand for their EPYC server processors. Those things are everywhere in data centers now.
And what's really impressive is that this EPYC strength actually managed to outweigh the problems with those MI308 shipments to China you mentioned.
It did. It shows just how strong the EPYC demand is. They lost a chunk of expected GPU revenue, but the CPUs carried the segment to growth anyway.
Incredible resilience. So, beyond EPYC, what else is happening in data center, especially around AI? That's the big buzzword.
Oh yeah, they're pushing hard into AI. They announced the new Instinct MI350 series GPUs. These are aimed squarely at generative AI and high-performance computing, HPC.
So the really heavy-duty stuff.
Really heavy stuff. And they also announced something called the Helios Rack Scale Solution, basically a pre-built AI system ready to deploy. Plus, they updated their AI software, ROCE7.
ROCM, that's their open source software stack. Why is open such a big deal for a hardware company here?
That's a great question. Being open means developers can more easily use AMD hardware, adapt it, build on it. It fosters a community, lowers the barrier to entry compared to, say, a more closed ecosystem. It's a strategy to get developers on board, which then drives hardware sales.
Makes sense. Attract the builders. And I saw some big partnership announcements, too.
Absolutely. Partnerships are key. Like Humane planning to deploy 500 megawatts of AI compute using AMD tech. That's massive.
100 megawatts. Wow.
Yeah. And Red Hat's using Instinct GPUs for AI inference. Nokia is using the latest EPYC processors in their cloud platform. Dell launched new servers built around MI350 and EPYC.
So they're embedding themselves pretty deeply.
Very deeply. They're powering 172 supercomputers now,
Wow.
including the world's top two, El Capitan and Frontier. It really speaks to their high-end computing power.
Okay, let's switch gears. Client and gaming, that segment just exploded, didn't it? Revenue up 69% year over year to $3.6 billion.
Yeah, that was the real standout this quarter. Just phenomenal growth. Client revenue specifically so, think laptops and desktops hit a record $2.5 billion, up 67%.
What drove that? Just selling more chips?
It was strong demand, especially for their new Zen 5 Ryzen desktop processors,
Yeah.
but also what they call a richer product mix. People were buying the higher-end, more expensive chips.
Ah, higher margins there too, presumably.
Exactly. And gaming revenue was also way up, 73% to $1.1 billion. That was boosted by semi-custom chips, think consoles like Xbox, and also good demand for their Radeon graphics cards. All that flowed down to much better operating profit for the whole segment.
So what new products are actually driving this?
Well, for the pros, they launched the Ryzen Threadripper 9000WX series. Monster chips for workstations.
For the serious power users?
Definitely. For gamers, the Radeon RX 9060 XT, focusing on giving good performance for the price. And they also brought out a Radeon AI PRO GPU for running AI tasks locally on your PC.
Interesting. Bringing AI down to the desktop.
Right. And maybe the biggest long-term news here. A new multi-year deal with Microsoft
Oh, yeah. For what?
to power the next generation of Xbox devices. Not just consoles, but potentially PCs and handhelds too. That locks them in with Microsoft for years across a whole range of devices. The big strategic win.
That's huge. Okay, last segment, embedded. That one dipped slightly.
Correct. Embedded revenue was down 4% to $824 million. They said demand was sort of mixed in those markets like industrial or automotive.
So a bit softer there.
A bit softer, yeah. But they're still making moves. They started shipping their new Spartan UltraScale Plus FPGAs. Those are programmable chips for cost-sensitive edge devices like in factories or smart city tech.
Right, FPGAs are super flexible.
Very flexible. And they're also working with Bosch on tech for robotaxis using their Versal chips for security and encryption. So even with the dip, they're planting seeds for the future in embedded.
Okay, shifting away from segments for a moment. There was this ZT Systems transaction. AMD bought it, now they're selling it. What's the strategy there? Seems like a quick turnaround.
Yeah, it does look a bit like that on the surface. So they bought ZT Systems to get expertise in building complete rack-scale AI systems, combining the chips, software, and the physical system design. It helped them scale up their Instinct GPU business quickly.
Okay, so that makes sense. Why sell it then?
They sold the manufacturing part of ZT to Sanmina for $3 billion. But, crucially, Sanmina is now becoming a preferred manufacturing partner for AMD.
Ah, okay, so it's more of a restructuring.
Exactly. It lets AMD focus on what they do best, designing the high-performance chips, the silicon, the software, the IP. They get out of the capital-heavy manufacturing game, but still have a partner to build their AI systems. It optimizes their structure, frees up capital, and lets them double down on core innovation. So focus on design, partner for manufacturing. Makes strategic sense. Okay, looking ahead then, what's the forecast for Q3? Does the momentum keep going?
The outlook is pretty positive, actually. They're projecting revenue around $8.7 billion, give or take $300 million.
Which would be another big jump. Yeah, at the midpoint, that's up 28% year over year and up 13% just from Q2.
Yeah.
And importantly, they expect that non-GAAP gross margin to bounce back up to around 54%.
Okay, so they see the Q2 margin dip as temporary, mainly due to those charges?
That seems to be the message, yes. A return to stronger core profitability.
And does that $8.7 billion forecast include any potential revenue from those MI308 GPUs going to China again?
No, and that's a key point. Their guidance explicitly excludes any revenue from MI308 to China. The license applications are apparently still under review by the U.S. government.
So if those restrictions get lifted or eased,
there could be potential upside to that forecast. It's an unknown right now, but it represents possible extra revenue not currently baked in.
Interesting. And what's the general feeling from analysts after all this, despite the stock dip initially?
Wall Street seems to see the bigger picture. The consensus rating is generally a moderate buy. They recognize the headwinds, especially the export controls, but also the underlying strength in EPYC, Ryzen, and the big AI potential.
Right. So quite a journey through AMD's Q2. It really shows how, despite that big hit from the export rules messing with the headline numbers.
Yeah, really skewed things.
The actual business, the demand for their server chips, their PC chips, their gaming tech, plus the big push into AI. It all looks pretty healthy, right? Lots of growth potential still there.
Absolutely. It's a really clear example of how these big geopolitical things, government regulations, can just directly slam into a tech company's financials, even when the tech itself is flying off the shelves.
So maybe the takeaway for you listening is next time you see earnings results that seem kind of mixed, maybe great revenue but weird margins, or vice versa, dig a little deeper. Ask, okay, what's really driving the core business? And are there any external forces like these regulations messing with the numbers?
Exactly.
Yeah.
Because that's often where the real story is beyond the headline.
It helps you understand the true health of the company.
Precisely. And maybe the thing to think about is this. In a world that's so interconnected, but also, let's face it, pretty unpredictable, with trade policies and controls constantly shifting, how do companies like AMD keep innovating and growing when they have to navigate this incredibly complex global landscape? It's more than just quarterly results, it's about long-term strategy and resilience.